we'll obviously be talking about the financial consequences of COVID-19 and some of the things that you should be considering when it comes to your credit report and your credit score, maintaining healthy credit. And here to help us with that conversation and to answer some of your questions. You can ask questions during the run of the show. Just send your questions in via Facebook, and we'll make sure we get to your questions as they come in. It's a very important topic, so I hope those of you who are watching today will ask questions. I'll remind you as the program goes on. But here to help answer some of those questions is Rod Griffin of Experian. Thank you for joining us, Rod.
Hey, Bruce, thanks for having me. Always glad to be here. Well,
I can't think of a better person to have based on the topic that we're talking about today. And, there's just... there's a lot going on that people need to know about. And unfortunately, a lot of information doesn't get to everybody. But first, the more important question, how have you been? How are you doing?
Well, the good news is I've been well. So we're, like everybody else, trying to do the right things, wearing masks and bathing in hand sanitizer and making sure we touch as little as possible and all of those things. But, so just trying to do what we can, and so we're staying well and staying in touch with the family in any way we can. So like everybody else, doing as well as we can be expected, I guess.
Yeah, and probably staying put, not doing much travel at all.
Yeah.
So for personal travel, that means you're saving a lot of money this summer. But there are probably other things to spend that money on. So.
This is true. Yeah, if you can find it. So. It's the markets or grocery stores are interesting still too, but yeah, we're like a lot of people. We canceled an autumn vacation that we've been planning for about a year, and so it's just gonna stay home and enjoy the dogs in the backyard, I guess.
You'll get to know every blade of grass in the backyard. That's for sure. Well, it's kind of the same around here. Just trying to be a tourist in my own town, enjoy the things that are around me, and not travel too far and stay safe. But so I think I wanted to open up the discussion here by talking about some of the things that are, I guess, most important for people to know when it comes to maintaining good credit and protecting their credit during COVID-19, and what may be different now for people in that area than it was at the beginning of the year.
Yeah, and it's been very interesting. And with the CARES Act expiring, Congress not as yet doing anything, the president making some declarations, and we don't know exactly what that means. So there's a lot of uncertainty in terms of what people can do and how their finances are going to be impacted. It's been a bit ironic in the first few months, since May, April, May, when all of this started, we've actually seen people's debt loads go down and their credit scores go up a little bit. So I think people, as you mentioned, are staying home. We're not spending money like we did. I think UPS, FedEx, and Amazon are staying busy, but we're not going out as much. We're paying down credit card debts. The credit card balances have dropped, and as a result, we've seen people with less debt and, in some ways, a better financial position, aside from the fact that they're losing their jobs and income. So, just kind of a big issue, and we're waiting to see, now what's going to happen. If there's no more stimulus, if we can't get back to work, what's the follow-on going to be? I think that's the thing that's looming at this point.
Well, and you bring up a couple of good points about, again, the impact where people are lowering their, paying down their debt. People are flush with cash, those who are fortunate enough to have jobs and a steady income during COVID, and maybe they've cut out commuting to work, and they've cut out travel, and they've cut out other things that would cut into their income. But those who are ending that run of good luck and maybe facing layoffs or cutbacks or other things that'll impact their income, they may be thinking more and more about turning towards credit as a lifeboat to get them through some difficult times, one of the things that we've seen in the news is that some creditors are actually going in and looking at individuals and cutting their credit limits, just going in and are seemingly arbitrarily just cutting their credit limits. What is the real danger of that? Is there any danger, and what's the consequences on somebody's credit when that happens?
Yeah, if your credit limit is decreased, it goes back to math. And with my journalism degree, I struggle with math, but this one's pretty simple, so I usually get it right. When you have your credit limit cut on a credit card, your balances become a greater percentage of your now available credit. So as a result, what we call your utilization rate or your balance to limit ratio goes up. And as a result, your scores will go down. And that's the issue. The impact of that is dependent on where you are in your overall credit history. What do you need to do with credit? Those sorts of things. If your credit limits are reduced, it's generally because there's been some other issue or it's signs of risk, and that's the lender's reaction to saying, or way to say, hey, you need to not spend quite so much. We aren't sure you'll be able to repay us. So that's generally the motivation there. But if everything's good, there may not be any significant impact on your ability to qualify. It just depends on your situation. So if your scores go down a few points, but you still have good, strong scores, it may not be something you need to panic about. On the other hand, if your scores are borderline, you're having some issues, then it can become a real challenge if you need that credit there for you to sort of, as you said, bridge that gap and be a crutch through a financial downturn, which can be a good use if you do it well.
And if your credit is good, if you're one of those who's fortunate enough that, going into that situation that your credit score is decent, let's say it's 790 or above, 800 or above, and somebody and a creditor cuts your credit limit for one reason or another, is it a good idea just to turn around in response to that and apply for new credit to make up for that gap?
Probably not. I mean, when you're in that level, you're doing the right things anyway. Generally, when you see a balance to limit ratio increase or a utilization rate increase, it's temporary in terms of the impact it has. It becomes clear you didn't take on more debt. You just had a reduction in your cards. Usually we see in normal times, if we ever get back to some semblance of that, people close accounts that they don't need and lose that available limit. And that's the cause of that reduction. In this case, lenders are reducing the balances potentially, but generally you don't see that as a lasting impact or a huge one. And if you have scores in the 800s and you have a credit limit decreased, your scores may go down. Even if they go down, if you have an 820 and they go down 30 points, you're still at 790. Then the lender's going to go, still approved. So it's the real impact that you have to look at. The challenge is if you go out and apply for new credit, you're not just getting a new account with additional available credit. You've also applied for a new account. There's no activity in that account. There's a new inquiry. There's new account. It's not clear how you're going to manage it yet. So what usually happens is that new balance that's available is offset by everything else. And so it doesn't necessarily help. The best course is to pay down the balances you have if you can.
And that those are good points, and that's always what we advocate for, is to go ahead and try to manage the debt that you have in front of you, pay down the balances that you can. Helps you out in a number of ways. Certainly helps make it look like your debt utilization ratio is better, and puts you more in that sweet spot, especially if you're dealing with a situation at a starting point where your debt utilization ratio is over 30% overall. Then obviously you want to start paying down debt rather than creating new opportunities to take on debt. I think
that's the other point, that if you open a new account, if you're having trouble managing the credit you already have, now you're tempted to take on additional debt with that new account. You can dig yourself deeper into a hole, not make it better. So be thoughtful about that.
Yeah, and so let's talk, while we're talking about managing debt. There's a opportunity right now for a lot of homeowners to refinance their mortgage, and there's a lot of interest in that because the rates are very, very low, and it's an attractive opportunity for people, especially now if they think they're going to need a little bit more wiggle room in their budget. It's a great way to lower the monthly payments and to even get a better interest rate and save money long term. What are some of the pros and cons people need to think of in terms of their credit when they have that opportunity?
Yeah, and it's right now. What's hard is we're seeing very high unemployment rates. 8, 10, 12%. Actually saw, I think, at one point maybe 14%. So we're talking about a large number of people unemployed, but that still means 86 to 90%, 92% of the population still employed, still receiving regular income, still working along, and we're hoping we can continue to do that. So if they have a regular income and everything is sound financially, it may be a great time to take advantage of a credit opportunity like that. Home loans interest rates are now at historic lows, and if you're planning to stay in your house for a number of years and your interest rates are a couple of points higher than what you could possibly receive, absolutely could be a great time to take advantage of that. It's one of those situations where there's opportunity and adversity for some, and in other cases maybe not. You still have to look at the mortgage like anyone else. I mean, there are lots of fees and down payments, potentially buying points, and will you recoup that cost depending on the agreement? So it means staying in the home for a certain length of time. So is the reduction enough to be worthwhile? All of those things have to be taken into account too, though.
Yeah, do the math, shop competitively, make sure you're getting the best deal, and then all the other pieces will fall into place. So another thing, we're kind of darting all over the topic map, but this is another thing that's kind of been in the news recently and has certainly has implications regarding credit score and credit reporting. But the benefits that people are getting from these forbearance programs and deferment programs, and I'm thinking specifically here about the federally backed student loans and the fact that borrowers don't have to make payments through December. And not only that, but the loans are not going to be accruing interest during that period of time on those payments. But yet it's going to be reporting, or at least from my understanding, it's supposed to appear as though you're making regular payments in terms of its impact on your credit score. Is that accurate, or is there something else there at play?
Yeah, no, it's not exactly. So when an account, student loans or others are reported as in forbearance, effectively what happens is that account payment history is frozen at that point. So there won't be any new updates unless it's positive. So if your account is current at the time you go into that forbearance period, it's going to remain that way throughout that period. There's no payment due, so there wouldn't be anything updated.
Right.
And then when the forbearance period ends, you pick up and start making payments again, and they'll start reporting those payments. If you have, say, a 30-day late delinquency on that account at the time it goes into forbearance, it's going to remain 30 days late throughout that period, unless you catch up, in which case it would be reported as current. So it wouldn't become more delinquent, but it could become positive.
So this is a good opportunity for people in that situation to regain control of their loan, get up to date, and bring their account current so they avoid going into default.
Yeah, it could be a really good opportunity, especially if you have other accounts that aren't due, and you can gain some flexibility. And like I said, I think that's where we've seen some improvement in scores and the way debts are managed, in part because of that kind of thing happening. Mm-hmm. But yeah, so it would stay delinquent, and then when that period ends, you would pick up, and you would still be 30 days delinquent if you didn't catch up on those payments. So
right.
So that's the way that works.
And that's a bit of a source of misunderstanding, because I think people who've been, and this is another thing I want to talk about as well, but people who've been checking their credit after they've plugged into these programs and they see their account is, even though they're on this deferment plan, they're still showing up as 30 days late. They get all upset because they assume that the account was supposed to be brought current in the deferment. It's not actually the case. So in those situations, the account would appear to be reporting accurately, and it is not a disputable item that they found, even though it may appear so based on their understanding. So it's very important for people to know why something is showing up the way it is before reacting. But going back to that, though, despite that fact, how important is it for people to be checking their credit regularly during this time? And why is it more important now, if it is, because of the circumstances?
It's critical. And for a lot of reasons, there are a lot of things that are changing. So we're all working on how do we make sure things are showing up properly? How do our lenders reporting things accurately based on the agreements you have with them? Are there things like disaster statements being put in place by the lenders so that you can get some additional protection potentially too? So are you using all of the tools and working with lenders to protect that credit history? So it's important to check it regularly. You can actually get your report free once every 7 days, once a week, through annualcreditreport.com right now through April 21st, April of 2021 at any rate. So through next spring. Whether you need to get it that often, probably not, but you can, so might be useful. And initially, if you're working with your lenders, you have multiple lenders, it could possibly make sense. You probably won't see updates that frequently. Still requires some time. One of the things I caution people is that if you are working with a lender and they're putting an account in forbearance, for example, don't run home from the bank after you've signed the papers and go get your credit report. It probably won't show yet. It still takes a billing cycle for it to be reported in most cases. So it could be up to 30 days, usually much less than that, but potentially. So don't panic if you get your report and don't see it. It doesn't mean that the account's not a forbearance. It just hasn't been updated yet. So another reason you check regularly and you'll see it as soon as it comes in the report.
But if you do have a dispute, another question that's commonly asked is, what's the best way to go about that? Should you first get in touch with the creditor and say, look, this isn't showing up right, I need you to fix this? Or is it better to go straight to the credit reporting agency where the inaccurate information is being reported and dispute it that way? Or should you do both?
Yeah, I say yes. No, so both. It's a good way to start. I think you always go to the lender because you need to make sure that their records are accurately updated, because that's what's reported to the credit bureaus. So if their records are updated properly in their systems, it will get to us accurately. But if you find something you believe is inaccurate in your report, you should always dispute it. It's free. It doesn't affect credit scores. It's easy to do today. And so just go to the online systems at Experian.com/dispute. We'll give you a free report in addition to all those other reports you can get. We can get a free one there. And you click the I need to dispute this button and follow the instructions. It's really straightforward.
Well, I'm playing devil's advocate a little bit here, but why not just go to a credit repair company? You see the ads on TV all the time, and they're saying they can fix your credit. And there's even an app now. It's from somebody who's saying, just click onto our app and we'll fix your credit. Why not go to that?
Yeah. And what's the saying? Fools and their money are soon parted.
Something like that.
Yeah, I don't. So the reality is in this situation, in situations like this, where people are frightened, they're uncertain, there's a lot of confusion, predators come out of the woodwork, and if it sounds too good to be true, it probably is. Mm-hmm. I always quote the FTC instead of me, but the Federal Trade Commission has said you cannot pay someone to remove accurate negative information from your credit report before the timeframes under the law. So you also have rights under federal law under something called the Credit Repair Organizations Act. You should know what those are. The first one is a credit repair company cannot take a penny upfront from you. The second thing is they have to provide a written contract. And the third thing is they have to fulfill all of the terms in that contract before they take any payment. So if a company says, if you give me, and I've seen them charge $700, $800, $1,000 per account to dispute that information, which is essentially what they do, you can do that for free. There's no reason to pay for that. Yeah. There are great organizations, nonprofits, something called NFCC. They have great members. It is at nfcc.org, and they provide great credit counseling and education and resources to help you manage your debts and do so in a way that's effective for you and to help you. So don't fall prey to things that sound too good to be true, because they almost always are.
Yeah, and I think the other important thing that might resonate with a lot of people is that what the credit repair agencies are promising to do is nothing that you can't do for free by just taking a few different steps. So, yeah, it's buyer beware in the credit repair space. And I appreciate you mentioning the Federal Trade Commission site, and also the CFPB has some guidance there as well. It's just it's important for people to understand what they're getting into there, most certainly. So, the other question I had too, which comes back to disputing, the issue of disputing. If you don't get your way and you feel like you've got to do something, some people turn to the opportunity to use the opportunity to put a statement on their credit report. There's you have the ability to add, I think, what is it, up to 100 words on your credit report as a personal statement. Does that even make a difference? Does it matter?
It does, and we always encourage people to do that. And we call it a statement of dispute because you're disputing the results of a dispute, and let you tell your side of the story. So yes, and anytime someone requests your report, a lender, landlord, whoever it might be, when you're applying for a new lease, will be notified that statement is on your credit file. So it does make a difference. Now, if you're applying for instant credit where they're looking at a score and like you go to the counter if you do that anymore these days, either at a retail store, and there's a sharp young teenage young adult child who is looking at you fill out the form and they say we can't give you credit because it's automated. That may not help. So instant kind of decisions, maybe not. But if you are applying for a major purchase, a car, a mortgage, especially things like that, they will look at your report. They'll see those things and let you tell your side of the story.
Right. But there are limitations as to what you can say or include in that statement, right?
Yeah, well, and just in terms of length, you can say anything you want within reason. We're not going to let you say vulgar things or hateful things, right. Things like that. But always caution people to make sure it's a reason for disputing. It's a reason, not an excuse. I mean, we've seen things kind of euphemistically call them statements of excuse. The example I always give is I got a letter from someone who wanted to add a statement that said, well, we went to Tahiti. Literally, had the letter. Said, we went to Tahiti on vacation, forgot to mail a check. So we want to make that clear in our report. That's why they didn't get paid. And I said, the problem with that is the lender's going to say, hope you had a wonderful vacation. I still need my payment on time. It's not a reason. Now, if
right.
illness or job loss or things of that sort, then you're saying, look, I disagree with the results, or I was never late, and here's why. And you can even include an upload documentation to show that. So,
but things that you can add that provide any additional detail that might help a lender make a decision, because I always used to say when I was in lending and also when I was in debt collection, the fewer questions that I have unanswered before I call you, the better that conversation is probably going to go. So I think it can be helpful in those situations as well. So the last thing I want to wrap up with, people right now who are thin file or no file, and they're thinking, well, good grief, in these times when you hear about how hard it might be to open up a new line of credit or creditors dropping credit limits arbitrarily, what options are available for me to start building credit? Any advice for people in that category?
Yeah, I mean, and there are several things. We think of them as alternative data sources now in the credit reporting world, and there are new tools that are coming available that people can use. One of them that's been around a while, if you have no credit history, you may be able to have your positive rent payments if you're leasing an apartment or renting an apartment at home, something like that. You may be able to your rent payments reported. And so if you go to Experian.com and search rent payments, you'll be able to find it. There's this really long URL I can never get right. So but go to Experian and search rent payments. Your landlord can work with third-party service providers that will then collect that payment information, report it to the bureaus. Experian doesn't charge to do that. The third-party service providers sometimes have a nominal fee, so your landlord should be aware. But what we usually see is either they'll pick up that cost if you're a good renter, it's fairly nominal, or add a little to your rent so they can report it. What we find is people who have their rent payments reported will establish, almost 100% of the time, they establish a credit report for the first time. They become scoreable, so they get started, or their scores move up in tier. So it can be a really powerful tool. And most bureaus, in fact, all three bureaus include rent payments or can. So that's something to look into. If you have an existing credit history, one or two accounts, Experian has launched something called Experian Boost that lets you report your positive cell phone payments, your positive utility payments, and now even positive streaming payments for Netflix. So it lets you show that, yes, I don't have an extensive history or a short credit history, but I'm still reliable and am still a good credit risk. I just don't have that history yet. So go to Experian.com/boost. You can learn how to do that. It's a free service. It's permission based. If you change your mind, you can say stop. We'll remove it. What we're seeing with Experian Boost is when people go through that process, we're seeing an increase in credit scores of about 13 points for 2 out of 3 consumers. For people within files, it's meaning fewer than 5 accounts, typically about 19 points. So it's a significant increase and a great way to give people some control over what's in that report.
And is that instant?
It is instant. Yeah. So what happens is you go to Experian.com/boost. We give you a free FICO 8 score so you can see where you're starting. You go through the Boost process and tell us which accounts you want included. And what happens is, since we're working with you, you tell us what bank account or checking account, savings account, or credit card you're paying that utility bill, for example, or your cell phone bill with. And then we are able to capture that payment each month from that account. And we'll help you identify payments you could add. So it could be a water bill, it could be an electricity bill, it could be natural gas, cell phone, and so on. And so we go back for each of those up to 24 months. And you would have, if you tell us I have a cell phone bill, a utility bill, so natural gas and water, we would capture all 3. You'd have 3 new accounts. We'll go back up to 2 years and capture that information. And then we give you a new score as soon as we finish that enrollment process, and you'll see what's happened. So instantly.
And what if along the way you miss a payment with one of those accounts that you have that's factoring into your Boost score? Is that going to negatively impact you?
No, we only report positive payments. So if you need to make 3 consecutive payments monthly, so you can't make 3 payments in 1 month. So we're looking for consecutive payments over time. And if those payments end or you become negative consistently, we will remove them from your credit report.
Okay.
So it's pretty risk-free.
And one more time, what's the website for people to go to find that information?
Really simple. www.experian.com/boost, BOOST.
Okay. And then for the rental piece, just go to Experian.com and search what we
just go to Google, go to your search engine and search Experian rent payment reporting.
Okay.
It's Experian.com/rent bureau/something, and I can't remember.
That's okay. Long URL. But Rod, any parting thoughts, any last advice, any topic that we didn't cover that you think we should have?
I think what we started with, don't be afraid to check your credit report, know what's in it, be involved. It's not complicated or nearly so as people think. And if you're engaged and involved in that process, you have control over it. And we want people to be able to use credit as a financial tool. It should not be a financial problem. Debt's the financial problem. And we want to help make credit the financial tool. So I always tell people you should be able to walk into a lender, know exactly what they're going to see, and be able to say, give me my loan because I know I have good credit. And we want that to be that way. We want to connect people with the financial services that they need.
Yeah. Well, thank you so much, Rod. As always, it's been great. The time has gone by all too quickly, but thank you for joining us today and being a great resource for our viewers. And of course, if anybody has any questions after the fact, if you're watching on demand, you can always send them in to us, and I might be passing some questions along to you, Rod.
And that's fine. Yeah, absolutely.
All right. Well, thank you so much, Rod. And thanks everybody for tuning in. We will see you again next week, and we'll have another topic for you on Facebook Live. So be sure to follow us, like, share, just click the heck out of our Facebook page. A lot of likes. All right. Take care, everybody.
Thanks, Bruce.